Today we are going to discuss one of the most important concepts in professional trading. Liquidity. Many traders believe gold moves randomly. Price breaks above resistance. Price breaks below support. Then suddenly it reverses. Most traders call this manipulation. But professional traders understand something different. Before gold makes a major move, it often searches for liquidity first. Once you understand this concept, many confusing market movements will finally start making sense. Let's begin with a chart. Chart 1, Equal highs. Take a good look at this chart. Notice how price creates few similar highs. Many traders see this and think, if price breaks above these highs, the market will continue higher. So they place buy stop orders above the highs. Other traders who are selling place their stop losses above the highs as well. Now think about what happens. A large number of orders are sitting in the same area. This area becomes liquidity. Professional traders know these orders exist. And very often, gold moves toward that liquidity before making its real move. What is liquidity? Let's simplify the idea. Liquidity is simply an area where many orders are waiting. You do not need complicated definitions. Just remember this. Where traders place orders, liquidity exists. The most common liquidity locations are above recent highs, below recent lows, above resistance, below support, above equal highs, below equal lows. These areas attract price because they contain a large number of orders. Why gold needs liquidity? Now you may ask, why does gold move toward these areas? The answer is simple. Large institutions trade very large positions. They cannot enter huge positions the same way retail traders do. They need enough orders on the opposite side. Liquidity provides those orders. This is why gold often moves toward liquidity before choosing its true direction. The market is not simply chasing stop losses. The market is searching for available orders. This is a very important difference. Chart 2, Liquidity Sweep. Let's look at another example. Notice these equal highs again. Many traders expect a breakout. Price moves above the highs. Buyers enter. Stop losses from sellers are triggered. Everything looks bullish. But then something interesting happens. Price immediately reverses. And gold starts moving lower. What happened? Liquidity was taken. Once the orders above the highs were collected, the market no longer needed to remain there. The real move could begin. This is called a liquidity sweep. What retail traders see? Most retail traders see a breakout. They think, the resistance is broken. This move is strong. I should buy now. Unfortunately, they are entering exactly where liquidity is being taken. This is why many traders get trapped. They buy the breakout. The market reverses. And they become liquidity. Chart 3, Equal lows. The same concept works in the opposite direction. Look at these equal lows. Many traders place stop losses below them. Some traders enter sell positions expecting a breakdown. Price drops below the lows. Everything appears bearish. Then suddenly gold reverses higher. Again, liquidity was collected. The market moved into the area where orders existed. Then the true move started. Common mistakes. Now let's discuss a few common mistakes. Mistake number 1. Trading every breakout. Not every breakout is real. Some breakouts are simply liquidity sweeps. Mistake number 2. Ignoring equal highs and equal lows. These areas often contain important liquidity. Mistake number 3. Entering immediately after a sweep. A liquidity sweep alone is not enough. You still need confirmation. Mistake number 4. Ignoring market structure. Liquidity works best when combined with structure. Never analyze liquidity by itself. How to use liquidity correctly. Before entering a gold trade, ask yourself 4 questions. Question 1. Where is the nearest liquidity? Question 2. Has liquidity already been taken? Question 3. What is the current market structure? Question 4. Am I looking at a real breakout or a liquidity sweep? These 4 questions can help you avoid many unnecessary losses. And remember, my friend, the goal is not to predict every market movement. The goal is to understand why gold behaves the way it does. When you start paying attention to liquidity, you will notice something interesting. Many moves that once looked random suddenly become logical. You begin to understand why gold often attacks highs before falling, why it attacks lows before rising, and why so many traders get trapped at important levels. Remember this simple idea. Price is often attracted to liquidity before it makes its real move. Master this concept, and you will start seeing the market through a completely different perspective. Thank you for watching, and I will see you in the next lesson of the Advanced Gold Trading Masterclass.